In this video, we're going to discuss a very basic but important concept in biotech investing, the concept of value. And we'll also discuss how to avoid one very common mistake that a lot of beginning investors make that's related to value. So this is the first in a series of videos that I'm going to make on investing in biotech. And I'm going to start with videos that are geared towards people with sort of at the beginning of their biotech investing journeys. And then we will move on to topics that are more advanced and hopefully relevant to a range of investors. So if you are interested in this topic, and if there's anything you want me to cover in particular, just let me know in the comments, or if there's companies you'd like me to use as examples in walking through these concepts, let me know in the comments as well. But for now, we'll just get into the first topic, which, as I said, is value. Actually, first, disclaimer, so this is an investment advice. This is just educational material. We're going to cover real world examples, but they'll all be out of date. So if you do try to invest based on that information, you probably will not do very well. All right, so now on to the topic. How value is created in biotech and also destroyed in many cases. So the value of a company is the present value of all the cash it will make in the future. Obviously, this is an estimate because no one can predict the future. But fundamentally, what investors attribute to the company's value is the amount of cash that it will generate in the future. There's a number of techniques that investors use to try to accurately estimate this, but it's ultimately unknowable, which is why stock prices fluctuate so much. And the stock market price, the market in general, is basically the aggregation of all investors' efforts to value a company. If investors think that a company is worth more than the market price says, they'll buy the stock, and then conversely, you'll either not buy it or sell it if they think it's overvalued. So it's important to note that value is not necessarily equal to price. Warren Buffett has a famous quote that says, "Price is what you pay, and value is what you get." And what I think that essentially means is that they're just different concepts. They're related, but different concepts. So value is what a company is theoretically worth. It's not technically knowable, right? Like we said, because it's based on the future. But it's theoretically just the fundamental worth of the company, the amount of money it will make in the future. Price is what other investors will pay, or what you are able to pay to purchase a share of the company. So a share of a company is basically you're getting equity in the company, which means that you get a share in the profits that a company makes, and you also get a say in how the company is run, because you can vote on different matters relating to the company's operations, strategy, management, etc. But to be a little bit more concrete, let's take a look at a stock and just see, what the price is and how it's valued and walk through that. So Google Finance is a pretty good resource for looking at stocks. So we'll look at Seres Therapeutics as an example. Seres Therapeutics is a microbiome company. They were started by Flagship, which is the same biotech venture fund that created Moderna, coincidentally, made famous by the COVID vaccine. But Seres is a different investment that they made that went public in 2016. So where do we find information on price and value here? So for price, pretty straightforward right here. $6.25 is the current price per share to buy a share of Seres Therapeutics stock. It's moving around a little bit because the market is still open. But if you want to buy a share of Seres Therapeutics, $6.25 a share. So what does that actually mean? What do you get if you buy a share of stock? Like we said, if you buy a share of stock in a company, you get equity in the business. You get ownership of the business. So if Seres, sold all their assets today and distributed all the cash and proceeds to its owners, if you had a share of Seres stock, you would get a portion of those assets. Now, obviously, Seres isn't going to sell themselves today. They're going to keep operating in the future. Maybe they'll sell themselves in the future. Who knows? So you don't value the share of stock based on what you get if the company were dissolved today. You value the company based on how you think the assets and the cash balance of the company is going to grow in the future. So that's basic information about the price per share of stock. How does that translate to the value of the company, though? We're also interested in that. So there's a bunch of different metrics to use to value a company. In this example, we're just going to focus on market cap, and then we'll talk about some other common valuation metrics in the next video. But market cap is basically the value of a company's equity. So you take the price per share, and then you multiply it by the total number of shares, and that gets you your market cap, which in Seres' case is $581 million. So Essentially, investors think that the value of Series equity is worth $580 million. So in the future, as the company gets drugs approved and commercialized, maybe the company gets bought by a bigger competitor. If you add all of those cash flows together, investors believe that that's basically worth $580 million. If you think it's higher than that, maybe you buy the stock. If you think the value is lower than 580 million, maybe you don't buy it. All right, so another consequence of what we've just discussed is that stock prices are driven by expectations about the future. Right, stocks are priced, at least in part, based on the market's perception of value, and value is the sum of the future cash that a company generates. This means that stock prices are driven by expectations about the future. So when an investor buys a stock, they're placing expectations on the company. They expect it to generate a certain amount of profit in the future based on however they've valued the company. And the price that they're willing to pay for a stock is based on these expectations. So when reality doesn't match up to expectations, in either a good or a bad way, investors reassess their estimation of value and the stock price moves. So we'll look at another example here to illustrate this. So we're going to move away from biotech for a second, take a look at Netflix. So we're going to go to their quarterly earnings. If you're not familiar with quarterly earnings, basically every quarter, which is every 3 months, a company releases how it performed financially in the past quarter. And this is usually one of the more important pieces of financial information that companies regularly provide to investors. So it's often a very important piece of information for a company's investors. So we'll take a look at what Netflix wrote to its shareholders for the first quarter of 2021. So if we zoom in, so this is basically just a letter from Netflix's management team that they put out publicly for investors so they can see how the business is doing. And in first quarter of 2021, what did they announce? Revenue grew 24% from the prior year. Right, 24% growth is pretty good. And that was in line with the beginning of the quarter forecast. So what does that mean? So basically, management teams will often provide to investors what is called guidance. So they will say, in the next quarter or the next year, we expect our revenue to be in a range of X to Y. And we expect our earnings or our profits or other metrics to be in another range. And this is just a way for management to help investors better value the stock and potentially remove a little bit of volatility. But it also does put expectations on the management team to perform. And it looks like they performed pretty well. So the revenue was in line with their forecast. Operating profit and margin reached all-time highs. That sounds like good news. And actually they beat expectations on profit. I didn't say that here, but they did. And then they finished the first quarter with 208 million paid memberships, which is up 14% year over year. Sounds good. But below their guidance of 210 million paid memberships. So that seems disappointing a little bit. So in addition to financial metrics, companies will also provide guidance on things like paid memberships or users or things like that. So what do you think this did to the stock? So things went up. Looks like it's a good business, it looks like. I mean, you probably have watched Netflix before and enjoy it. This revenue has consistently grown. Their operating income, which is a form of a profit, has consistently grown, it looks like. And their earnings per share are also growing. And then you see the strong growth in memberships as well. So the business seems to be doing well. But what happened to the stock? So let's see what happened to the stock on April 20th. So let's see. Let's go back 6 months. Okay, so March, April. Okay, here's April 20th. And then, okay, so it looks like there was a massive drop in the stock price on April 20th. But it looks like, I mean, there was some good news here. The fundamental business seemed to have done pretty well. But apparently, investors expected something more, and the company didn't deliver, so there was a huge drop in share price. And I think what happened was that this number here was pretty concerning to investors. The fact that they expected 210 million paid memberships, only got 208 million. And I think that there was a concern among investors that there was increased competition in the streaming market from like Disney Plus or Hulu or other services, and they're really focused on the competitive aspect because that's going to determine long term how profitable this business is. And maybe revenue grows 24% year over year because it was COVID or something like that, so people streamed more. Although I guess part of that would be incorporated in no, that actually wouldn't be in the first quarter of last year. So that's probably part of the reason for the revenue to grow. So there's a short-term, tailwind, but then long-term, there's competitive concerns. Investors don't like that. Stock goes down. So the lesson here is that a good company is not necessarily a good investment, especially, on a short-term basis. So as you saw previously, Netflix's stock went down, even though it grew revenue and profits. It had record profits, stock went down. Revenue grew 24%, stock went down. So this is one of the most common mistakes that beginning investors make, which is if you think a company is good, then it's definitely a good investment. So a lot of times people will analyze a company, they'll look at the financials, the fundamentals, or in the case of a biotech company, you'll analyze its science, and then you'll conclude this is a good company. It's likely to grow profits in the future, I'm going to invest. But that's not always the case. As we said before, the price of a stock is determined by investors' expectations of future profits. If you think a company is going to triple profits in the future, but other investors think that the company is going to quadruple profits, have even higher expectation than you do, you may not want to invest. In fact, if you're right and they triple their profits, but the market expects them to quadruple, you're going to lose money. So you could be right, the company could do super well and triple their profits, and you might lose money because investors expected more. So you always need to be careful of that. So how do you avoid this mistake? In addition to analyzing whether you like a company, you need to analyze whether you like the stock. Do you expect its future cash flows to be higher than what others expect? And why do you believe this specifically? So clearly and specifically articulating why you believe a stock is worth more or less than what other investors think it's worth, that's called an investment thesis. If you just say that this company is going to grow its profits, it's a good company, or this drug has an 80% chance of FDA approval, that isn't enough. That's necessary but not sufficient. It's not enough for an investment thesis. You also need to compare your assumptions to what the market is priced in, and then defend why your assumptions are different and better than the market. That's obviously hard to do, which is why investing is difficult. But we'll talk a little bit more about developing theses in later videos. But before we end this one here, just want to walk through an example of a biotech company to see what moves biotech stocks. So we're going to walk through Seres Therapeutics again. So like I said earlier, it's a biotech company. So this is a microbiome company. They were started by Flagship, which is a venture fund, very successful fund. They were actually the same fund that created Moderna Therapeutics, which has been the biggest, most successful biotech investment probably ever. And Seres was one of the earlier investments that Moderna made that went public. So Seres has a number of different products in their pipeline. They don't have anything approved, though. They have 3 things in the clinic, but no approved drugs. Obviously, no approved products means no revenue, no cash flows and profits. So if you don't have any historical profits or revenue or anything coming in the near term, how would an investor estimate future cash flows? So in Netflix example, it's a bit easier, right? Management provided guidance as to the range of revenue and profit and earnings that they expected. And then investors can take that number, see whether they believe it or not, but there's pretty good bounds on what those cash flows would look like in the future. And if management doesn't provide guidance, you can also look at a company's historical financial performance that will give you a pretty good grounding as to what to expect in the future. But for an R&D stage biotech company, you don't have this info. So let's take a look at Seres' stock chart and see what moves their stock price. So Seres here back on Google Finance. This is its total stock history. So I'm going to go back to its IPO in 2015. It seems like it was a very wild ride. So it did well when it first went public, went down, up, huge drop, and then for several years it sort of sat, and investors didn't like it too much. And then all of a sudden they fell in love with it, and then they fell out of love with it again. So before we get into what drove this sort of roller coaster ride, I just want to point out the magnitude of these drops in stock price. So here in 2016, Seres went from like 35 bucks a share to 10 overnight. That's a massive decrease in value. And then here in 2020, the stock went from $3 one day to $27 another day. So that's like an 8x increase in value, basically overnight. So compare that to Netflix. I mean, Netflix, it looks like a lot of ups and downs here, but if you zoom out, it's you don't see anything that big and that dramatic. And in fact, this is only like an 11% drop in the stock price compared to, this like 8x leap you see overnight for series. So this is a characteristic of biotech stocks, is they happen to be a lot more volatile, a lot bigger price swings, just because you have less confidence in your ability to predict future cash flows of the business. So let's get out specifically to what moved the price, let's say in this binary event here in August of 2020. So one good way to see kind of what happened at the stock price at a given date, you just go to the SEC's EDGAR database. So this is a helpful resource for financial information. It's the Securities and Exchange Commission website. And then you go to the site, you look for, let's say, Seres Therapeutics, and then it pulls up all the SEC filings. So these are just financial documents that companies have to file with the Securities and Exchange Commission, so investors can be educated about what they invest in. And in particular, we're going to look for a filing called an 8K. An 8K is something that a company puts out when they need to announce a significant event for shareholders. So it's kind of similar to a press release, and you can also find this info just by going to a company's website and finding the press releases, but here we're just going to go straight to the source. And again, we're looking for August 2020. So you can either enter the date range here, or we'll just scroll down to August 10th. So what happened? What happened that day? So on August 10th, they posted an updated presentation, very dramatic. But basically what they did is they announced positive top-line results from a phase 3 study. So that seems like a big deal, right? Phase 3 studies are typically kind of the last studies you do before approval. They're highly risky and expensive studies. And they did it in the C. diff indication. And basically, won't go through the full details of the study, but the study met the primary endpoint. So it succeeded in the endpoint of reducing the recurrence rate of C. diff infections. So the patients who got the drug only had an 11% recurrence rate compared to 41% of patients who received the placebo. So again, won't go through the details here, but if you want more information, you can go to the press release, which is pretty similar to the 8K filing, but you can check that out if you want to. And then you can also look at their presentation. So oftentimes when companies announce results, they'll put out a slide deck that has more detail. So we won't go through this in full. You can find it on either their website or the SEC website. But basically, this follows the design and format of a lot of other presentations like this, where they walk through the sort of highlights, discuss the study design in detail, or well, a high level, and then provide detail later on. Discuss the top-line efficacy results, look at safety, and then just go into more detail on the data from the study. So the upshot here is that it seemed to work. So the stock went up a lot. And actually what happened back here in 2016 is Seres studied that same drug and the same indication, but I think they used a lower dose, or there was another difference in the study design, and that phase 3 study failed. So here you see investors basically wrote the company off, and it sort of sat in the doghouse for a number of years, and then it shot up. And part of the reason why this was such a dramatic increase in price was not just because the study succeeded, but because investors did not expect anything of this study, right? The previous study failed. They redesigned it a little bit. Oftentimes it's sort of a salvage effort that companies will make to see if they can get kind of one last hurrah at success. And in Seres case, it worked. So the stock went up a lot because good news, low expectations equals big stock jump. They had another study that didn't work out so well later in the year, which eroded a lot of the gains, but that just kind of is biotech for you. Just to wrap up, value in financial value is driven by estimates of the future cash flows that a company will generate. And for pre-revenue biotech companies, the value, you estimate value not based on financial information, because you typically don't have that for pre-revenue companies, but you estimate that based on scientific information. So while you have a lot less financial information to go on for biotech companies, you have a lot more data on how the products perform in a lot of cases, and a lot of higher quality data than for other industries, right? So you saw a placebo-controlled, well-designed, randomized clinical study that showed how well this drug performed. And a well-designed study like that, in addition to a little bit of market research, can actually give investors a pretty good amount of confidence as to how a drug will perform as a product in the market. So if you understand the unmet need in a disease, you understand the standard of care, what other drugs and treatments are being used, and then you understand how a study design, the implications of whether the data the drug generates and the design have on whether it will be used by physicians, then you can get a pretty good understanding of what's going to happen with the drug in the market. So if a drug works better than what's out there, as shown by clinical studies, investors can be a lot more confident that the drug will be approved by FDA, prescribed by physicians, and then ultimately reimbursed by insurance companies. So all of that together means you have some reasonable expectation of the future revenue and profits and cash flows generated by a drug. So that's why a lot of investors in biotech spend most of their time trying to estimate the probability the drug will succeed in a trial and then understand the degree to which the drug provides a clinical benefit over the standard of care in a medical condition with a high unmet need. So that's why these clinical studies are so important. Additionally, the clinical studies don't just have a large overall impact on a stock price, but they do it very quickly, as you saw, like overnight. And that's just because clinical studies are typically blinded, so the results are not known until the end of the study. And then all of a sudden, there's a bunch of important information revealed at once. So that's why you see such huge movements in such a short period of time. So that's the last thing I wanted to cover in this video. Again, just talked about value in biotech. Next time, we'll talk about measuring value. So we talked about market cap today. We'll talk about some other metrics that you can use to measure value in finance and compare the value of one company to another. So hopefully you guys liked this video. Hopefully it was worthwhile. If you have any feedbacks, again, let me know in the comments. And if there's things about investing you would like me to cover in the future, let me know as well. So thanks for tuning in, and hopefully we'll see you guys next time.